I think you're still grappling with the end of the quarter and the end of the half, and people are trying to figure out how to both rebalance their portfolios and secondarily how to prepare themselves for what may or may not be happening in these trade wars. As the days wear on, we're finding out more and more things. For example, one of the key areas that China was going to quote-unquote punish the U.S. was in an area like soybeans. Well, now we're finding out that China's need for soybeans may be greater than they can satisfy somewhere else. So while they may impose tariffs, we may have Argentina or somebody act as an intermediary, buy the soybeans here, and then deliver them to China. More importantly, however, we're finding out that China imports so little from the United States that they can't put on tariffs big enough to really make a difference. So that's bringing us to Sarah's favorite area, currencies. And it may mean that they will use their currency to begin to punish the U.S. That's why we've had some of the afternoon destabilization we've had recently.
The Journal today looks at non-tariff options. They argue unlikely that they're going to dump treasuries, for instance.
Well, I mean, that'd be self-punishment. But by simply stopping buying, however, that will help raise rates here and move things up, and they can hold for a different time. More importantly will be this currency thing, where that winds up going. And you're seeing that affect other markets. The emerging markets area is pulling back, worried that a currency destabilization out of China is going to change all the emerging markets. So we're into kind of a new phase of the trade wars, and that's why every time the market seems like it's found a bottom and is ready to move, not going to happen.
Yeah, I mean, it brings it back to our markets, Art, which is the last time China devalued its currency, it wreaked all sorts of havoc across world markets, including the S&P, led to a correction. The U.S. dollar is getting pretty strong here on a trade-weighted basis. Is that going to start to hurt earnings and the economy?
It is, and I think you're already seeing it as a factor. As I said earlier, the strength of the dollar and the fear of an overt move by China in currencies has the emerging markets moving around. So you've got all of the pieces juggling in midair, and it's tough to really settle it down.
Art, the financial stock weakness, it's pretty hard to knit it directly to trade stuff, but plenty of other excuses, I guess, between what's happening with the yield curve and then European financials, obviously, like Deutsche Bank hitting new lows. So how does that filter into the whole story?
Well, it's not just, you're right about the European banks, et cetera, but the financial group as a whole is having its worst performance in about 40 years. And you know, if you look at the ETFs and other things, they've been down for 12, 13 straight days. You don't see that kind of performance. Now, in the past, when you've seen something vaguely like it, they've tried to turn. They don't turn so rapidly. They eventually do, but they don't turn as rapidly. So I think what you need to do is find out what's happening with the ECB and the European banks, and then watch what's happening with the currencies in the emerging markets. That will affect all the financials. We're flattening that yield curve even further here.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.